Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. The allocation that investors have to the stock market has been declining very aggressively ever since 2021. Now you can see this indicator, the allocation that people have to stocks is great at signaling when the market is getting frothy, when it's getting overextended. You can see we had the same signal in 2021 that we had in 2018 right here, just before a 3-year period of consolidation on the market. In 2015 right here, before two consecutive 15% drops in the market. And then, of course, similar to the allocation that investors had leading up to the top of the dot-com bubble, that of course led then to a 15-year period where the market went sideways. Now we are back to the allocation levels at around 60%, which is typically what you see on average during a bull market. So we've taken out all the frothiness, all the overextension that we had in 2021, it's out of the market. But if we zoom out on this chart, you can see that during actual bear markets, during real recessionary bear markets like 2001 and 2008, allocation goes down a lot further. This move here is what you can really say is capitulation for the retail investor. That comes at the end of a bear market where investors basically panic sell their stock at the bottom of the bear market before stocks go on a multi-year bull run. The same thing again happened in 2009. Capitulation happened in the second half of the bear market, and this is where the market drops the most. The second half of the bear market in 2009, that was a 50% drop from that second half. Right between May 2008 and March 2009, the second half of this bear market, the market dropped over 50%. And in the second half of this bear market, between August 2001 and January 2003, the market dropped another 40%, right? So the majority of the losses come during that big capitulation event at the end of the bear market that a lot of people right now in 2022 are saying, this is what's coming. This is what's in store for us over the next year. So the question we're going to be answering in this video is that true? Is that what's in store for us? And if so, should we be taking advantage of this bear market rally to hedge against a real capitulation event in the market, a real bear market? That is exactly what we are going to be covering in this video. By the way, if you are new here, don't forget to smash that subscribe button if this is the type of content and videos that you'd like to see more of. And of course, if you learned something new in this video, if you appreciate the way it's been put together, don't forget to smash that like button. And now without further ado, let's get right into it. Now, let me start off by quickly making a very important point here. Now, over the past few months, we've seen the allocation that investors have to stocks plummet, right? So people have trimmed a huge amount of allocation to stocks from their portfolios. And of course, as a result, we've seen the allocation to cash come back up to the same levels that we had during the pandemic. So what this means is that the rally we are seeing now is not liked by many people. A lot of people took their money out of the stock market over the past few months. A hated rally is not about everybody betting on downside and buying put options for the market to go down. What makes this rally hated by a lot of investors is that over the course of the past few months right here, a lot of people trimmed down their position in equities. And you can see that just through this chart right here. You can see since June, right? This is the June reading where stock market allocation was at 65%. That was almost the very bottom of the market. And look at where allocation is now. It's at 62%. So between June and today, the market is around 5 to 10% higher than it was, and yet people's allocation to the stock market has gone down. So investors are evidently not very happy to be seeing the market rally. This is what I mean when I say that the market rallying right now is the pain trade. Now, of course, we've been saying that for some time because of how bearish sentiment was. We thought the low was in back in June and that we wouldn't revisit the low. Of course, we were wrong on that. But there's a few other very interesting things that are happening in this rally that I'm going to show you right now. Now, this indicator is the SP 500 stocks above their 200-day moving average. We love to look at this. This is such a powerful tool to use. The participation that stocks are having in a rally can tell you so much about the real strength and sustainability of that rally. And I can show you a very simple example right here leading up to 2021. Right here, look at what the SP 500 breadth was doing leading up to that 2021 top right there. The market was heading higher and the breadth was falling. This was the signal that told you that the market was going to correct. Now, of course, what we said, what we haven't said is not important. We have to focus on looking forward and learning as much as possible from our mistakes. So I personally like to focus on the areas where we got things wrong, try and understand those mistakes and not repeat them in the future. But if you're skeptical that this indicator actually means anything, take a look at this video from back in December or January when we looked at this exact phenomenon. The breadth was degrading, the market was heading higher. That was signaling that a top was coming right as the Fed was talking about the beginning of its tightening cycle. So this can be a very powerful indicator to time tops. And what we're seeing today is actually kind of the opposite of what happened here. Because look at this divergence. You have the breadth right here that's heading higher, making a higher high, right? The number of stocks that are trending above their 200-day moving average is moving a lot higher than it was in August. So a much broader, a much stronger rally that we're seeing today than we did during the summer. But if you look at the stock market, well, it's making a lower high. So there's this underlying strength in this rally that we're just not seeing in the technical picture. Now, if we look back at a couple of examples where this actually happened, 2018 was another one of these. And you can see what the stock market was doing right here. Back in February 2019, right here where my cursor is, the stock market had not taken out its November highs from November 2018. And yet look at what the breadth was doing. It was surging higher. The breadth here was a lot stronger than the rally that we had in 2018, which had very little participation. Now, if we zoom out a little bit further, go back to 2016, for example. You can see here between July 2015 and March 2016, there was a clear downtrend in stocks. Right? March 2016 was a lower high relative to November 2015 and July 2015. But look at what the breadth was doing. Yes, it made a lower high in November 2015, but then in March 2016, look at where the breadth was. It was higher, telling you that there was a lot of participation in this rally, despite the fact that the market hadn't exceeded its previous high. So this was a positive internal signal in the market. Now let's go back further to the 2008 financial crisis. And again, let's take this high from December 2008 and look at the breadth. It's confirming that stocks are moving down. But then look at what happened in the 2009 recovery. Boom, March 2009, look at where the breadth is. It has surged. Huge participation in this initial rally off the low. And so the breadth in June of 2009 was actually higher than in August of 2008 when the market was all the way up here. Big divergence in 2008 that was telling you, yes, the market is recovering in a big way. And by the way, we never got any signal like this throughout the bear market. First of all, look at this high and this high. Look at what's happening to the breadth. Big drop in the breadth. This was a massive warning signal for investors that the market was weakening here. Then you've got this high right here that also shows weakening breadth. Then you've got this high right here, lower participation in rallies. Then you've got this high right here, lower participation in rallies. So at no point during the 2007-2008 financial crisis did we see the positive divergence that we are seeing now. Now, of course, the market today is at resistance. This couldn't be a more clear level right here. Just a beautiful trend line. There's clearly some reasons to expect that there's going to be some short-term turbulence. First of all, well, we've had already a 17% rally off the low. So the market can pull back after such a massive rally. You're definitely not going to see a straight line up. So a pullback in the next few weeks is very possible before the market heads higher. And of course, this is something that we're actively covering on the website at gameoftrades.net, where we have our key targets, buy entries for all the assets that we have on our model portfolio at gameoftrades.net that we think are going to outperform the SP 500 in the current macro environment over the next 6 to 12 months. And by the way, we don't have the S&P in the model portfolio. We're trying to outperform the S&P 500. Otherwise, you could just buy the index fund as a passive investor. The idea and goal that we have as investors is to be able to outperform the S&P 500 over the long run, whether that is in a tough market environment or a bull market. And that's really what we're striving to do every single day. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.